If you put your money in a savings account and earn 3% interest a year, how would you feel if you were taxed 100% on that interest income? Probably not very good. If you put a $100 deposit in and after the first year you made $3, and with a tax rate of 100%, all of that $3 would get taken away. But how would you feel instead if inflation was 3%? Well, most people would be pretty okay with it. In fact, over the last century, inflation has been around 3% a year on average. But in both cases, whether you're making 3% and getting it completely taxed away, or having 3% of your capital inflated away, the end result is the same. Your capital is 3% less than what it should have been. I think this is an interesting perspective to look at inflation because it is the economic equivalent of a tax, and similar to other taxes, understanding it is the first step to mitigate its impact on your personal finances. Hey folks, Liquid here, and welcome back to the channel where we talk about how to protect our money in economic downturns and where to allocate our money so we can thrive when the economy gets better. In this video, we're going to look at the inflation numbers, some economic data, and try to make sense of what's going on in financial markets. Warren Buffett gave this great anecdote one time where he says, "The arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by legislature. The inflation tax has a fantastic ability to simply consume capital, and it makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income tax during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. She would find 100% income tax to be outrageous, but doesn't seem to notice that a 5% inflation is the economic equivalent. The more money you have and the more money you make, the more inflation eats away at it. So when put into that context, what Buffett said is kind of worrying. But what's even more problematic is inflation today isn't at 5%. The latest inflation number just came out in Canada, which is for the month of May, and it was 7.7% annualized. That is at a 39-year high. Nobody likes high inflation, so that's why policymakers are doing what they can to lower the inflation rate. Generally speaking, central banks can increase the policy rate in order to curb inflation, and that's what Canada and the United States have been doing, along with New Zealand and to some extent the UK. However, other nations like Japan and other countries in Europe have not yet increased their policy rates for the fear that their economy may not be strong enough to withstand tighter monetary policy. Canada and the US have definitely been the most aggressive this year, but there is a limit to how much interest rates can rise before the economy is going to take a hit. And I think we're coming up to that threshold right now. You've probably seen my previous videos about companies laying off workers. Consumers are spending less in stores, and now the bad news is spilling into the financial industry, with Wall Street facing billions of dollars in losses. Oil has come down from its highs, and along with everything else, Bay Street is down as well. TD Bank, one of my largest holdings, was doing relatively well earlier this year, but now it's down 22% from its all-time high. Companies are rescinding job offers. This is quite rare because normally when a company doesn't want to hire anymore, they stop looking for new job applicants and stop doing interviews. But when they rescind a job offer, then that means the turnaround is so quick. They went from let's hire more people to let's undo the hiring plans we made a week ago. So things are changing very quickly. And what I'm paying very close attention to right now is the United States unemployment rate. Here's a chart going back to 1950. And notice how when it falls, generally speaking, it's more gradual. However, when the unemployment rate goes up, you can see that it's usually a very large movement and it moves very quickly. Right now, it's sitting at 3.6%, which is very low by historical measures. As you can see here, it doesn't fall below 3.6% very often. It goes to 3.4, 3.5, maybe lower in some instances, but I would say we are pretty much near the bottom of this unemployment rate cycle. And if we're near the bottom, then that means we're going to see it go up. And historically speaking, again, when it goes up, it does not touch the sides. It just goes straight up very abruptly, very quickly. And if that happens, then it's going to throw a wrench in what the Federal Reserve is trying to do with the interest rate hikes. So it'll be interesting to see what they do then. It would totally suck if people are losing their jobs and inflation is staying stubbornly high and we have interest rates going higher, so it'll cost people more to manage their debts. That's basically stagflation, and it's my base case for what I think is going to happen in the next 6 to 12 months. So right now is the time to start planning for what you want to do if something like that were to happen. On the job front, it could mean having a backup plan, networking more, or developing a side income. Gather any material that you might need from your current work to help you pivot in your career, following your company policy, of course. And on the investment side, I think if you don't already have a property, now is probably a good time to start looking at something to purchase. Inflation is probably going to stay high for some time, and one of the best asset classes to combat inflation is real estate. That's because you can get ahead in three ways. The first way is through rent. Rental income typically goes up higher than the rate of inflation over time, so that's one way you can keep your purchasing power. Another way is through debt erosion. As inflation gets higher and higher, the value of your debt, like the mortgage that you owe on the property, also becomes less and less valuable. And less debt means more wealth, relatively speaking. And then the third and final way is, of course, through capital appreciation. As long as you do your homework and you buy in an area that is relatively desirable, then over time, you should see the value of your property increase by at least the same level of inflation, if not more. So, would I be buying a property today? Probably not, because I don't think the market has factored in A, the higher interest rates that we're seeing, and B, lowering demand because people will have less money in a recession and they won't be able to afford a lot of homes on the current market. But I think right now is a good time to save up for a down payment and potentially buy a home in the next 6 to 18 months, which at that time I believe real estate prices in both Canada and the United States will be lower than what they are today. But if real estate doesn't interest you, or maybe you already own a principal residence that you're living in and you want to look at opportunities in the financial markets, then you might not have to wait 6 to 18 months because the stock market typically bottoms before the depth of a recession. So, a couple of weeks ago, I was referring to this purple line, and I mentioned that this is for the NASDAQ. I mentioned this is the 200 weekly moving average, and when it hits it, then that's probably a signal that we are either at or near the bottom because as you can see previously, it kind of followed that purple line up. Basically went down, almost hit it, going back up, went down, hit it, and went back up. And right now, we just recently hit it, but before we haven't yet. So now I think that it actually landed on the purple line here. This may have been a bottom, although it's hard to tell because the momentum overall over the last several weeks is still on a downward trend, as you can see from this green line here, which is the 10-week moving average. So if I jump over to the S&P, we have the 200 weekly moving average here again, also in purple. And similarly to the NASDAQ, you can see it kind of follows it and it goes up. It rarely dips below it. The only time it did was in 2020. But most of the time, when the stock market goes down, it just drops, touches it, and then just bounces back up like it has in previous years. So we are very close to that purple line right now, maybe another 5% or 10% drop, and we'll be able to hit that. Maybe we'll even go under a little bit, but I think at that time, I would say it's a pretty good possibility that that is the bottom. So when that happens, I will probably put something like half of my the money that I've earmarked for the stock market. I'll probably put it in. I don't want to put 100% of my money in at that point yet because, you know, like in 2020, it could go further down, and I don't want to risk getting margin called. So that's how I plan to manage my risk that way. But I'll definitely be picking up some very attractive stocks at very good valuations. And maybe at that time, the economy will be so bad that the Federal Reserve will start to become accommodative again. When that happens, you do not want to miss out on putting your money into the financial markets. This is something called the Cantillon Effect, which is something that a lot of wealthy people do, which is kind of risky, but for people who know what they're doing, this strategy basically turns inflation into an advantage instead of a disadvantage, because essentially you're trying to buy assets before monetary policy pushes their valuations higher. And it's not just people with a lot of money that can do this, pretty much anybody can, as long as you have some money. I actually have a whole video about the Cantillon effect over here, so you can check that out if you want to know more about it. Thanks a lot for watching, happy investing, and until next time.